So now we need to get into leverage. Leverage, the main thing with leverage is the loan to value ratio. So it determines how much a bank will loan against the value of an asset. Now, as I said before, every asset's different. With property, the loan to value ratio, or LVR as I'll call it from this point onwards, is generally 80%. And what that means is if you want to buy a property worth $100,000, the bank will give you $80,000. You need to find the $20,000. So if you've got the $20,000, you can then go to any other bank and get the $80,000 because they're pretty happy with that. What the bank does is looks at it and says, well, if they don't pay their loan, we could afford to sell the property for 20% less than it's worth and still get all our money back. So they don't care about your 20k, they just want to make sure their 80k is covered. So each asset can be higher or lower. So in property, the property level is generally around 80% is what most banks are happy to do without proof of income or without too many checks. But if you go into different types of property, it varies. If you go into commercial property, it's probably around 60 to 70% LVR because they classify that as a higher risk. If you go to a country property that's on a massive amount of acres, again the bank says, well, there's a higher risk there because if we did need to sell it, there's probably fewer buyers that would want to buy it, so they would lower the LVR. If you go across to a different asset class like shares, shares you can get up to 80% even higher with shares, but with shares you are liable for something called a margin call. So if you have shares, you may know what this is. What that means is if you've borrowed money to buy shares and they drop in value, the bank will make you correct your position to keep at your specific LVR. So for example, if you'd borrowed 80% of the value of your shares, and let's say tomorrow the share market drops in value quite drastically, the bank says, well, hang on a minute, the value of your shares has dropped a lot and your debt's still at the same point, so now we're exposed too much, you'll need to sell some shares. And they'll force you to sell shares when the market's going down, which is not what you want to do. So with property, you don't have that risk. So let's move forward now. What I want you to do is imagine you've got a home and your home's worth $500,000. What we're going to establish is how much equity do you have and how much can you use. So here's our home at $500,000. We're also going to say that you owe about $250,000 on it from your home loan. So if you simply do the maths, your equity in your home is about $250,000. And you might think, well, that's great, I've got a lot of equity, I can go out and spend it. But realistically, you can't just go out and get $250,000 off the bank because the bank looks at it in terms of the LVR, like we just mentioned. So the bank might say, well, we'll give you an 80% LVR loan. So what they'll say is that the property's worth $500,000, and they'll say, well, the first 20% we're going to keep. Okay, so if we take 20% of $500,000, that's $100,000. You can't touch that. We're going to hang on to that just in case something goes wrong. We can't afford to sell your property a bit cheaper and get our money back. So then we have to take off our debt, so we owe $250,000, which means the bank would give us about $150,000 to spend. And there's a big difference there, isn't there? There's a difference of $100,000 between your actual equity and the equity the bank will give you. So how do we get more of it? Well, if we went to 90% LVR, so when you go above 80% in borrowings, the bank will generally charge you something called mortgage insurance, and I'll cover that in a moment. But let's say we did do that, we went to 90%, it means the bank would only hold $50,000 of it back for themselves. They'd take your debt off of $250,000, and then they'd say, okay, you can have $200,000 to go and use as you please.